example 2 for chapter 4. So we have a job manufacturing company that uses a predetermined overhead rate based on direct labor hours. We have estimated direct labor hours for the year for 95,000 and total estimated costs of $617,500. We have some various information about 2 different jobs that we've been working on. We know that job A was completed during the month of September and job B was started but not finished. So the first question is, what is the total cost of job A? When we're looking at the total cost of a job, we record 3 costs. We have direct labor, direct materials, and overhead. So we're recording September inventory amounts. Well, we have $65,000 was requisitioned for job A during the month of September. So we're going to add $65,000 to job A. Direct labor costs, we had direct labor hours on job A of $4,200. So, and we have a direct labor rate of $8.50 per hour. So our direct labor for job A is 4,200 hours times $8.50 per hour. Our overhead amount is based on our predetermined overhead rate, which we still need to calculate. So we have total estimated factory overhead divided by our total estimated direct labor hours. That gives us a rate of $6.50 per direct labor hour. Job A had 4,200 hours times $6.50 per direct labor hour to apply overhead. The last thing that we're going to calculate in job A is that we have work in process inventory from job A. So here we have work in process inventory, which was all part of job A's expenses. $31,200. So the total cost of job A is $159,200. Second, we have what is the total factory overhead applied during September. To calculate the overhead applied, we would need the total direct labor hours times the $6.50 per hour. We can see in question 3, we also want to know what the over or under applied overhead is for September. So let's make a T account for overhead to calculate our costs. We know when we allocate or apply overhead, we record that on the credit side of the account. And when we record actual expenses, we record those on the debit side. So for job A, we had $27,300 in overhead costs. On job B, we had 3,500 hours times $6.50 per hour is our allocation for job B. Now we need to record our actual overhead costs so we can determine if we are over applied or under applied. So we'll look at all of these amounts over here and try to determine what we need to put in inventory. We have direct materials, direct labor, labor costs. We have indirect labor. Indirect labor goes into overhead. Supervisor salaries are recorded in overhead. Factory rent is an overhead cost, and indirect materials used. If we sum our credit and debit amounts, we can find out if we over or under applied overhead during the month. So what we calculated is that we over applied overhead. Make sure that we got all of our overhead expenses. Factory depreciation costs. We've over applied overhead by $4,000.50. The next example that we're going to look at are the journal entries to record normal spoilage, abnormal spoilage, normal scrap, and scrap that is common to all jobs. So when we manufacture, we have a normal amount of scrap and spoilage. Sometimes our scrap can be sold. We're going to record the sale of scrap and the sale and our spoilage. When we record spoilage, normal spoilage, we record that to our spoiled material inventory. We keep track of what material has gone bad, and we remove that cost from our work in process inventory. So these are materials that we moved into work in process inventory, and then something happened to them that made them unable to be used for the product. So we have here that we have normal spoilage for $300. We record our normal spoilage for $300. The second journal entry we're going to record is our abnormal spoilage. When we record abnormal spoilage, we record that at a loss. And then we have, for this job, Y34 is what we're recording for. It says that we have normal spoilage for $400 and abnormal spoilage of $200. The normal spoilage costs we're going to put into overhead. The abnormal spoilage we record a loss for. This is spoilage beyond what we normally account for during a period. And we're going to remove the full amount from our work in process inventory. So those are the journal entries for normal and abnormal spoilage costs. We'll talk about spoilage and scrap in more detail in a later chapter. Now we have scrap sold in relation to job Y34, we sold that for $80. And then we have scrap common to all jobs for $120. So first we're going to record the scrap sold for Y34. So we received $80. And we're going to reduce the work in process inventory related to job Y34, $80. We earned income on that job scrap, so we're going to reduce some of the cost that we had originally given to that job. When we have scrap that is common to all jobs, we record that to overhead. So the scrap that was common to all jobs, we received $120 for, and we credit overhead for $120. These are the journal entries for spoilage and the sale of scrap related to job costs.